No one is talking about the fact that gold has hit a very critical milestone. This indeed has the potential to significantly alter the future of gold. What I mean is that cost is just one factor. While we go in, let's talk about it. For reasons beyond their price performance alone, 2025 was a fantastic year for gold and silver. In 2025, more than ever before, central banks are elevating gold's status as a commodity and monetary metal. Within the time range of 0.45 to 0.57. However, 2022 was the year it all began. We will discuss that shortly. Although I'm not buying as much gold as I used to, I am still adding to my holdings because of the recent price increase, time interval, 0.58 to 2.57. Well, my pals over at Summit Metals have gold in a very handy form. These adorable miniature wallets are available for purchase. You can get little gram bars from Scottsdale and place them in these genuine metal containers. It's a lovely, stylish method to add to your collection in a compact portable package. They will also purchase from you. Compared to the pricing listed on their website, this month they are giving my visitors higher buyback offers on gold, silver, and platinum. If you are looking to sell, you should check it out and contact them by phone or email. Mention that Uncle Sal or Salivate Metal sent you and they will give you a better price. However, gold is a precious commodity that, unless there are very unique circumstances, I believe we should mostly hold on to. But I find this really interesting. From what I gathered from FinShots, it's astounding that central banks are in charge of determining the value of currency, and naturally, we hold different views on this matter. Do not be mistaken, investing this kind of capital is a losing endeavor. Contrast this with gold, which is a stable medium of exchange. Absolutely, without a doubt. For the first time in nearly 30 years, though, they did it clandestinely. The worth of the gold stored in their vaults surpassed that of the US treasuries they possess. This is happening for many different reasons. That is a significant change, though. This is analogous to finding out that your grandma's jewelry box is worth more than the fixed deposit she has boasted about for decades. That's basically what occurred, but on a far larger scale. Because of that, some things change. This is a rather remarkable shift. 309 to 257. For many years, US government bonds were among the most secure investments you could make. They are known as treasures. They play a significant role in international finance for multiple reasons. Time period, 309 to 437. In the end, the borrower is thought of as the US government. It is not legally able to bankrupt, unlike a household or business. The explanation why is obviously obvious to us. Simply put, it can always print more money or increase taxes to cover its debt. And just so you know, the majority of it involves printing cash. Both of those statements are technically incorrect, though. Reason being, they're actually more into digitizing than printing. You can make a dollar appear out of thin air with the press of a few buttons. Physical gold is becoming more important as our society becomes more reliant on digital transactions. It is something that central banks are aware of. This explains why, beginning in 2022, they have begun making a show of literally amassing gold. The answer is yes. This means that the United States is the ultimate borrower, and it will never run out of money because it has the ability to print more. Then, there is the treasury market, which is the most liquid and deepest market in the world, with investors holding around $29 trillion. The ability to purchase and sell them within minutes is a significant advantage for central banks managing their reserves. In contrast to idle cash, treasuries actually pay interest. That much is certain. Yes, they do. The sentimental favorite, though, is gold. However, before we delve into that, I must say, the current situation is truly remarkable. Between the timestamps 437 and 939 money that isn't being used does nothing. Despite the fact that currency loses purchasing power over time, it is always wise to have a little amount on hand in case of an emergency. Plus, selling it is unnecessary. To accomplish this, you are not need to sell your gold. Imagine it as a safe zone. In my opinion, it is beneficial for central banks to maintain a stockpile of US dollars or other liquid assets. Definitely, it's a smart move. Nonetheless, central banks' preference for gold is well known. Despite its glimmer, vault, and undeniable history, it remains unyielding. The effect is not amplified, it is not profitable. Plus, storing it is expensive. Therefore, unlike in previous years, central bankers were hesitant to include it in their balance sheets. The reason behind the change in the value of central bank holdings is because, well, the price of gold went crazy. From almost $2,000 per ounce in 2024, it increased. Consider it. $2,000 was the price of one of them only a year ago. It's nearly twice as much now. Since 2022, it has definitely doubled. It is undeniable. And now it's just above $3,550. It might be slightly more or slightly less by the time you watch this video. That meant the value of the bars that central banks already possessed seemed incredibly bloated, even if they hadn't purchased any more. However, they continued to purchase almost 1,000 tons of additional gold in 2024, with 410 tons purchased in the first half of 2025 separately. Worldwide, central banks have shown a strong devotion to gold, and the value of treasuries has declined. It all boils down to the value of the dollar. Even while we hear a lot about the rupee's decline, the value of the dollar has been falling as well. Actually, the dollar's strength is best understood in relation to other global currencies. Put simply, they're all filthy. This is the washing basket's cleanest shirt, if you will. That is the point at which the bull is down. Even though we often bring it up, its purchasing power has declined significantly over the years. This depreciation has been noticeable since the Federal Reserve Act began in 1913. We also know that the dollar and the Federal Reserve were both established to control the amount of money in circulation in the United States, considering that $100 is worth exactly what it is. Thinking at it through the lens of a $100 bill will let you transport back to 1913. Absolutely, in 1913, $100, like the one you see here, was a ton of money. The Great Depression also saw the criminalization of gold ownership. There is a depreciation of the dollar compared to gold. In addition, the same goods and services may now be purchased for $131 by 1933. Yes, I understand. At $131 or $133, this is the base price. The Bretton Woods Agreement further solidifies the dollar's position as the world's reserve currency by linking it to gold. Put another way, countries can save up dollars, and then those dollars can be exchanged for gold. At that point, it will be $172. Put simply, this is gone, and gone much more so. So, basically that's the situation. The total is $172. Then there's Nixon, who ended the gold standard and shut the gold window entirely. Also, that happened in 1971. Then it rises to $406, which in 1913 would cover the cost of $100. The 1987 financial market volatility, sometimes known as Black Monday, followed. Afterwards, we're discussing $1,134. In 1913, it is the amount of money needed to be equivalent to $100. Then, in 2007 and 2008, there was a worldwide financial collapse. It has nearly quadrupled that to $2,153, which is equivalent to what $100 would buy in 1913. Around 2013, we observed that the Fed's efforts managed to maintain a constant inflation rate. By that point, the amount had risen to $2,350. After that, there was the tremendous stimulus during the epidemic era, which further depreciated the currency. $10.50 to $9.39. When gold finally hit $2,000 per ounce, it was a historic event. However, in 1913, $100 would have bought $2,570 worth of products. Therefore, the value is the same. What was priced at $100 in 1913 is now priced at $3,150. The dollar's worth is steadily declining due to persistent inflation. You can now see the reasoning behind part of this. There has been a 30% decline in its worth from January 2020. That is, the dollar's value. The price of a chocolate bar has increased from $1 in 2020 to $1.30 in 2021. Inflation accounts for that 3 millicents or 30% disparity. However, the treasuries become complex at that point. Every day, they provide returns of about 4%. Your actual return, however, will be a meager 1% if inflation averages 3% annually. You can end up losing money if inflation continues to rise at a rate greater than 4%, and that is precisely what transpired in the past, 30 minutes to 13 minutes. Going all the way back to 1971, when the gold window was closed, the dollar's purchase power has been steadily declining at a rate of around 4% per annum. That, when put into perspective, is very astounding. What has led to our debasement is essentially that. Debasement, in our minds, means cutting into the value of a currency by reducing its precious metal content. In antiquity, we witnessed the Romans doing the same thing with silver denarii. When the money supply increases at a quicker rate than the economy, value is gradually diluted. Today, central banks are paying the US government to keep US bonds unless yields go above the 4% debasement rate, so this is important for them. The United States' mounting debt of almost $37 trillion makes one question if bond guarantees are being handed out on napkins. This change could be attributed to the way reserves are managed, particularly in light of the events of 2022, when Western nations abruptly frozen Russia's reserves, which were worth billions of dollars. The world's central bankers were spooked. Despite their seeming stability, treasuries can only be as secure as the rules that control them. In contrast, gold is magnificently passive. There is no plan. The vault houses the bars that belong to the central bank. A claim isn't all it owns. It is the sole owner of the asset. We have seen this earlier in a different form. Inflation reached double digits in the 1970s, when the United States severed its links to gold. For bondholders, the real return on investment in treasuries was a loss year after year. The price of gold shot up from $35 an ounce in 1979 to nearly $400 by 1980, and even briefly hit $850 in 1981-1980. Even central banks made adjustments at that time, prioritizing gold over bonds. Things aren't quite the same as they were then. Because the dollar accounts for about 60% of world reserves, markets have become much more complex. When compared, inflation is far lower. The debt is high, trust is shaky, and gold is back in style, yet the rhyme is obvious. Doesn't imply that treasuries and the dollar are dead ends. They are still necessary for purchasing oil, settling foreign commerce, and issuing sovereign bonds between 1314 and 1425. But now, central banks aren't banking on the treasury as their exclusive source of funding. Gold represents sovereignty, while treasuries continue to provide liquidity. That holds great significance. Both are necessary for a well-planned reserve portfolio. In light of that, it is very remarkable to witness this. Additionally, we must determine the significance of this matter. However, assuming this is indeed the case, a historical analysis reveals that the disparity between US Treasury holdings as a proportion of foreign reserves has been steadily shrinking since 1970, before seeing a reversal in 1995. On a massive scale, it is now merging in the opposite way. You can see how the world's importance for gold is growing from there. This should also play a significant role in our personal lives. Take up the role of your own bank. I pray this movie has been enlightening, helpful, and instructive for you. Thank you so much for watching. We would really appreciate it if you could subscribe, like, share, and comment on the video. The transcription was performed by turboscribe.ai. To get rid of this message, go for unlimited.